You have been sold a lie about retirement. The lie says you should work until you are 65, save whatever you can, and hope that everything works out somehow. But what if you could build a 10-year dividend machine starting from nothing and aiming for $3,000 per month in income far faster than anyone ever told you was possible? You do not need lottery tickets or a huge salary. You need a boring and predictable dividend strategy, a clear foundation phase, and a small, intelligently used slice of accelerator risk. In this video, I will show you exactly how one fictional character, Harry, built his own 10-year dividend machine, starting from zero. Meet Harry. He is not a Wall Street professional. He earns about $65,000 a year. He has no trust fund and no unexpected inheritance. What he does have is a moment where he says he is done with the idea that retirement only begins at 65 if he is lucky. So he adopts what I call the 10-year dividend machine strategy. In years 1 to 3, he builds the foundation. In years 4 to 7, he begins adding an accelerator. In years 8 to 10, he optimizes and reinvests tactically. His strategy rests on 3 pillars: SCHD for stable and growing dividends, VNQ for real estate income exposure, and DIIV as the accelerator ETF. We are going to walk through each step as education, not as personal advice. Most investors either play it far too safe and grow much too slowly, or they chase high yields and end up blowing themselves up. Harry takes neither path. He uses a barbell approach. One side provides stability through SCHD and VNQ, making up the bulk of his portfolio. The other side supplies high-yield rocket fuel through DIIV in a controlled amount. Later in this video, I will show you the moment where he stops reinvesting everything automatically and begins holding cash so he can strike during market drops, which is where his returns start to accelerate dramatically. Harry is 32 years old. He looks at his retirement account and sees almost nothing. His inner voice says that if he continues like this, he will work until he collapses. So he sets a 10-year target. In 10 years, he wants his investments to pay him around $3,000 per month in dividends and distributions. Not because he wants to retire immediately, but because he wants options and breathing room. He commits to living below his means, avoiding unnecessary car upgrades, cooking at home instead of ordering out, and investing a fixed percentage of every paycheck. The strategy he chooses becomes the dividend machine. SCHD becomes Harry's first pillar. It invests in high-quality dividend-paying companies and has shown strong dividend growth of roughly 10 to 11% on average over the past decade. It provides a blend of income and price appreciation. And for Harry, it becomes the salary replacement base of his future dividend machine. In years 1 to 3, he does not care about how big the payouts are. He cares about consistent contributions, reinvesting every dividend and letting the snowball begin to form. The second pillar is VNQ, a real estate investment trust ETF. It gives him diversified exposure to property income without the hassle of managing tenants or buildings. VNQ behaves differently than traditional stocks and helps smooth out income across sectors. During the first 3 years, Harry builds both SCHD and VNQ positions while reinvesting every dollar. This phase is not glamorous, but without it, the accelerator phase later would be pointless. Now the strategy evolves. Dive becomes Harry's accelerator ETF. It typically offers higher yield, sometimes in the 6% range, but comes with more volatility and slower or even declining dividend growth at times. That is why Harry caps DIV at about 20% of his portfolio. The remaining 80% stays in the stable combination of SCHD and VNQ. DV is not a core holding for him. It is rocket fuel designed to boost total cash flow and accelerate compounding during years 4 to 7. Every dividend he receives from DIIV is reinvested back into the dividend machine. Around year 5, Harry begins to operate differently. His portfolio has grown enough that dividends feel meaningful. Yet he is still in accumulation mode and exposed to normal market swings. Instead of blindly reinvesting every dividend as soon as he receives it, he keeps contributing regularly while allowing some dividends to build up as cash. He waits for pullbacks or sector-specific dips and then deploys the accumulated cash when SCHD, VNQ, or DIIV become temporarily discounted. By doing this, he is no longer just compounding. He is buying more shares at lower prices, which amplifies future income. This tactical approach can significantly outperform purely passive reinvestment. While Harry is building his dividend machine, he is not living like his peers. They upgrade their cars, finance new gadgets, and take expensive holidays. Harry keeps his car longer, cooks at home, and cuts unused subscriptions. He views unnecessary spending as destroying future dividends. Every $100 wasted today is future monthly income lost. The dividend machine is not built on secrets. It is built on boring discipline, delayed gratification, and the refusal to sabotage his own future. By year 10, depending on his monthly contributions, market performance, and discipline, Harry's combined SCHD, VNQ, and DIIV portfolio can realistically generate 4-figure monthly income and, in some scenarios, approach the $3,000 per month target he set. The principal remains invested and continues producing income. At this stage, he has not completely won the game, but he has created real flexibility, meaningful options, and a powerful income engine that continues growing even if he slows down his contributions. Here is the recap of the 10-year dividend machine strategy. In years 1 to 3, he builds the foundation with SCHD and VNQ, reinvesting everything and prioritizing stability. In years 4 to 7, he adds acceleration through DIIV up to around 20%, while continuing to reinvest aggressively. In years 5 to 10, he begins operating tactically by building a cash buffer and reinvesting strategically during dips to scale the machine toward his income target. None of this is magic. It is patience, mathematics, and mindset. If you want a detailed spreadsheet walkthrough of how this could look with different monthly contribution levels, comment the word machine below. Make sure to like the video, subscribe, and share it with the friend who still believes retirement simply means working until 65 and hoping for the best. Retirement is not an age, it is an income stream.